Okay, very good morning. Thursday, the 5th of April. Hope everyone is well. Going to cover mainly the reasoning behind the recovery in the equity market last night. S&P finished up just over 1%. Nasdaq about 1.6%. The Dow Jones finished up about 1% as well. So despite the growing negativity we were seeing yesterday morning after China kind of upped the ante on the trade tariff front, markets actually have recovered quite sharply during the latter part of yesterday's session all the way into the US close. So we'll have a look at the reasonings behind that and then look at the calendar for the day ahead, a couple of things to look out for, and then I hand you over to Sam as per usual, who will look at the market a little bit more technically and what he's looking at. So first off, just looking at these charts, obviously you can see US futures seen higher after what was a really strong move after Europe had really gone home. We had already started to recover. I think it was at this point here, if you remember the actual news flow when it was coming out, if I just kind of identify a few different sections of price activity, again, sparked by the catalyst of the fundamental news breaking. If you remember, it's just before 9:30, we had those comments from China talking about targeting tariffs, and we'll have a look at these things like soybeans, but US agricultural products, cars in particular as well. And that created then the first meaningful response from China in regard to the $50 billion kind of tariffs that have been proposed by China on the US. This then initiated the thinking that, well, that means then the US are probably going to ramp it up to the next level, and then this tit-for-tat process has commenced, which is the overall negative for the global economy. Everyone loses in that scenario, as we've discussed before. Then though, at the bottom of this move, obviously this came as US, so this was like 11:30. So this is when New York, Chicago start coming into the market. And then of course, dear old Donald wakes up and tweets, and everyone's waiting with bated breath to see whether he, talks aggressively as in, how dare China come back and do this, we will show them. But the complete opposite. He said, I don't want to see a trade war at this point. And then really ever since that tweet, the market started to turn around, sentiment started to pick up, and a few other things did occur, which I'm going to talk about in more detail shortly. But that move continued all the way through the European close, and then as we've been seeing quite recently, quite a big ramp up in the last hour or so of US trade. Asia participants have come in, seen the developments, and they've carried it even higher as well. So consequently, if you're looking at the European indices this morning, we've had a gap up in the DAX, and the DAX already up about 200 this morning, and above the levels that we were printing at the highs when we finished trade back on the 29th, so last week. So strong moves. Gold then, as such, reversing a lot of the gains that were seen yesterday. You can see that sharp uptick that we saw. This was, again, the news flow when China came out and kind of with a retaliation, if you like, with their own latest targeted tariffs. And then the recovery and where we are at the moment. So again, that flight to safety bid that was supporting prices yesterday is being reversed. And then obviously with this de-escalation, if you like, and more calming words from both sides has meant that the dollar has recovered, and the Dixie's trading up about just shy of 0.2%. So both major FX pairs here in the top left are down about 16, 17 pips at the moment. Euro dollar, and again I'll leave this more to Sam to talk about, obviously is seen a test down at that recent support point of the last, well, this week really, Monday, Tuesday and Wednesday, I should say, these 2 points here. Briefly had a run on that and an S1 before we've seen a bit of a reversal here. Cable likewise, a bit of pressure, sub pivot for the moment. All right, let's have a look at some of the headlines then. So first off, obviously talking about the tariff talk really is the dominant theme that's driving financial markets on the intraday perspective, at least at the moment. And this is the headline: US-China push time to talk message as trade tensions rise. The main point being here, the US and China indicated they are willing to negotiate on escalating frictions, helping ease fears among investors that tit-for-tat trade dispute could derail the strongest global expansion in years. So remember this chap here, Larry Kudlow, who's the new White House National Economic Council director, trying to calm markets, so on and so forth. So again, a bit of a reversal from where we were just a couple of days ago when the US were being quite forceful with their message. This is Kudlow doing the opposite, saying there's still time to starve off tariffs, and is prompting then a reversal in sentiment in that regard. Now you might ask, well, why have the US changed tact so quickly? Well, don't forget what exactly China did. We discussed this particular reference to soybeans, and a lot of you might not be familiar with that. You know, we discussed it quite a bit yesterday, but one of the things here is about initiating a trade war with China. The president, i.e. Trump, may be hurting some of the people that he promised to help during the election campaign. So this is when we talk about what Trump is doing is could hit hardest the people that got him into the White House in the first place, the political heartland. So, you know, hours after Trump initiating his 50 billion, obviously China responded, and they were targeting quite surgically and cleverly, I think, that they would hit key US farm exports such as soybeans, beef and so on. These are important to the economies in normally reliable Republican farm states such as Iowa, for example. An initial round of retaliation unveiled by Beijing was targeting these US exports from these politically important states like Wisconsin as well, for instance. Now, this is interesting because obviously in the context of what's to come for this year, the end of this year, we have the US midterms, and according to polls from Real Clear Politics, so anyone who's traded things like the US election, you'll remember Real Clear Politics. They're like the benchmark aggregator of all the polls in the US, and Democrats currently have a 7.2 lead in the 2018 midterms. Now that is down from around a 13-point lead in December, but there's still a significant lead to the Democrats, and don't forget the entire Capitol Hill structure, both chambers of Congress, is currently fully Republican. So there's a lot going on here where, we talked about this before, Trump political posturing in order to appease the heartland, but this response from China is quite clever, and what's interesting is to see the administration immediately back off, the foot off the pedal, once China are really hurting the voters that Trump knows he needs the most to keep on side, if that makes sense. You know, China's really hitting him where it hurts, and in that respect, he needs to then, you know, de-escalate the situation. One of the other things that you've had, of course, is, you know, it's not just about China. There is NAFTA. NAFTA seems to have become yesterday's news and being pushed to the sidelines, but this still is a big deal. And Trump has softened the key NAFTA demands on regional car content. So not only is he softening now on the China side, he's also softening on the NAFTA side. So all of a sudden, you've got this complete turnaround in sentiment, and consequently, hence the reason why the market saw a very risk-on type movement yesterday. That's why markets are up quite sharply this morning, and as such, gold and treasuries are lower because there's renewed risk appetite in the marketplace in that respect. Just to give you an idea as well, because it's a question, good question that I had yesterday from Bogdan in the live trading room, and he was asking about, you know, when are these tariffs actually going to happen? You know, are they happening now? What's the deal? And talking to a couple of the guys at IG, they basically told me that US companies have until the 22nd of May to submit objections to US tariffs on China. The US government then has at least 180 days to decide whether to go ahead. So it's not like Trump saying we're going to do XYZ is going to happen immediately the day after. Actually, the likelihood is that this never ends up getting implemented in the first place, and it's just a shot over the barrels, if you like, in a kind of political move of force. So this is all just conversation at this point. Obviously, financial markets move with repricing for future expectations, and so hence we see the movement we have seen. But as I say, I think some calm to the situation and some rationalization, if you like, has returned, and we're back higher again. A few other things to have a look at, though. Undoubtedly, volatility has continued. And I mean, comparative to the end, particularly Q4 of 2017, where ranges were incredibly tight. Just to give you a statistic, the S&P 500 has posted its 26th move of 1% or more this year. That is already triple what we had in total of 2017. So, you know, quite incredible how all of a sudden the market's kind of sprung back to life. Obviously, one of the bigger catalysts pre this tariff situation on trade was that of the biggest risk, which was heightened speed of synchronized tightening from the central banks, if you like, globally. And that obviously has taken a bit of a back foot now, just given these latest developments. But the Fed are still tightening, and we still expect at this point at least the Fed to tighten the 3 times that they've committed for this year, having already executed 1. This was an interesting chart, of course, which the guys have been looking at. I was asking Sam, you know, did he take it? And I'm sure he'll talk about this. You know, Sam was looking at this a couple of days ago and looking at the fact that I think it was US election, well, go back before that, EU referendum, we dropped below the 200 DMA in the S&P and then rallied. US election, really quick flash through the level, and then we rallied. The question being, you know, do you have the steel downstairs to hold a position and try and go long on that level? I mean, if you did, you've come out of that very nicely, but I'd say you would be incredibly brave as well. But yeah, that level seemingly doing the same job that it's done on multiple times before. So far so good, but I think, as Sam was probably suggesting before, it's going to be interesting to see how it closes the week, and does it close above that level, which probably will make him a bit more confident, I'm sure. Other things are more near-term levels. This was just something I saw from JP Morgan Securities. They were looking at where's the next line of support, and this is kind of breaking it down a little bit of a more short time frame. So this is looking at 2017-18, and they're looking at the bounce in a kind of zone, 25.17 to 57 is what they're looking at. You can see that kind of double bottom, if you like, from the flash sell-off that we had on that market correction from the spooked wage improvement and consequent heightened risk of inflation and policy tightening. We got down to that low, where the market really has bounced at this point in time. Another level, this is again getting even more shorter dated. That's looking at that bottom of the February sell-off of where we were at. So this was printed on the 8th, 25.81. So this came, I think payrolls, if I remember rightly, was on the 2nd of February, and then it followed with the following Monday. That was when the market really got hit on those fears of policy tightening. That was the eventual low we saw a few days after, and here we are hitting that price point and bouncing, and just around that 200 DMA as well. All right, a few other things just to talk about quickly. Did have some data from Germany this morning. Not going to spend too much time talking about this because I really think it's a moot point, but something to just be aware of. German factory orders did miss slightly expectations, but the Economy Ministry of Germany did say they see further momentum despite the recent slowdown demand for investment. And then one of the other things are, this was on Bloomberg, top pound forecasters are bullish as Brexit worries are overplayed. So what this is looking at, basically Bloomberg have constructed a table of the highest ranking percentages of the most highest accuracy. To be quite honest with you, I don't think I've heard of most of the top ones at the top. Probably about half of these I've never heard of. Just quite interesting to see that a lot of them probably make these smaller firms the ability to be a little bit more far-reaching and outlandish with their calls. So when they get it right, obviously, you know, their accuracy in that respect can be quite tight with their forecasts. But the point being is that on an average basis, most people are now bullish. The talk is we've averted the cliff edge scenario with this transitional deal that's been agreed. So therefore net in the foreseeable future, i.e. for the rest of this year, in the context as well with a continuation of dollar weakness, well then cable's got to go higher. Not forgetting as well, we're going to have an interest rate hike in May. Some bank economists also believe we could see an interest rate hike later on in the year. So for a medium, longer term kind of idea of positioning of where the pound will go, there's a growing chorus on Wall Street and beyond that the only way is really up for cable. And we've talked about this before. Obviously the dynamic is with this trade talk, this is going to restrict possibly the hawkish hand of the Fed. So if the Fed just remain in this gradual, cautious rate hiking cycle and the political risk dissipates around the Brexit issue, well, this should be supportive then of the cable long. The only things I guess to be aware of from a timeline point of view with the Brexit conversation is going to be a few things. You've got really 3 events that are on my radar. One is the May local elections, but I'd say that's probably dropped down as a lower tier ranked event now that Theresa May managed to secure the transitional deal. Then you've got the summer. I think at the end of the summer is when there's going to be the vote in Parliament about whether or not to remain in the EU customs union. And obviously, as we know, Parliament is very fractured, almost completely equally at 321 apiece. So that could go against the PM, which would disrupt the process as a potential risk. And then, of course, you've got October, which is the hypothetical deadline where Brexit needs to have some more concrete structure to the framework of the agreement in order for then it to be ratified amongst all the European parliaments and so on. So there's a few things to be aware of, but on the balance, economists seemingly are sitting on the side of that this is going to continue, and actually it's been a bit overplayed, the whole subject. Don't forget though, even though these guys are looking for some quite punchy calls for the, almost a complete reversal of the entire referendum move, the actual consensus is 142 and we're trading a 141 handle, so it's not too dissimilar from where we are at the moment on an average median consensus. Alright, quick look at the calendar, a few things to be aware of. As we go through the morning, we do have the various European country service PMIs, but these are final readings, so these aren't going to have a material impact on market prices. The one that I do want you to be aware of though is if you're trading FX and you're looking at the pound, you definitely need to be monitoring the service PMI number. That's coming out at 9:30, as we've discussed before, and as you guys know, our economy heavily dependent on that particular sector as the biggest driver of GDP, and so this will have a material impact on the pound in the short term. Expectations are 54, got a range 52.5 to 54.8. I was just having a look here, even the lower and upper bound of that number doesn't really shake up the 12-month readings too much. I mean, if you actually look at the range that we've had with this data, it has been quite wide. On the bottom side, we'd need to see a sub 53 number really to raise a few eyebrows, and on the plus side we need to see really a 56 plus number, both of which would be way over and above the current analyst forecasted range. So definitely I think you should look out for that if you're looking at the pound. But one thing I would say, and one thing that was clearly evident yesterday, if you're trading Forex, it's still about the dollar at the moment, I would say. No one's talking about Europe and the ECB in terms of right here today on the intraday. Brexit is yesterday's news. It will re-emerge as a topic, I'm sure, in months to come. But for the moment, no one cares about Brexit. What we care about is this global trade spat that's ongoing, and that's the crucial factor that's going to move these currency pairs, which is by default the movement of the dollar. So again, I would say looking at the type of reactions in the currencies, this is short-term price volatility. The bigger overall trends will develop from the narrative on the trade front. Otherwise, looking into the afternoon, US international trade, challenger layoffs, so lower tier numbers ahead of non-farms on Friday, your regular jobless data as well. All right, let me hand you over to Sam. That's it from me. So I wish you all a good day. Thank you.
Good morning, guys. Yeah, so we've got a bit of data coming out from the EU at 9 o'clock, so I'll try wrap up just a bit before that, and of course then the UK data at 9:30. Just to start off with the pound, actually, just using the 60-minute chart, you can see this is, well, here we go back looking at the last sort of few trading days up to the 29th. It's really stuck within this range, and every time it sort of pops above, well, R1, little false breakout if you like, to then come back down, and you probably get a bit of a trend line even going from these highs up through there, marks up quite nicely with today's R1, and then you've got the pullback on the 28th. I think that sort of area as a whole could be quite interesting. Very range bound at the moment. I mean, if you just you can see those highs, those lows, definitely for a considerable sort of push either way. I think even today is going to be quite unlikely. I know non-farms tomorrow could offer that, but it looks like it's going to be very much contained within this sort of range for now. A push above yesterday's and today's high, and R1 I think does look good as a level to look to go short. If we were to push below the range, and that does seem quite a fair way away from where we are now, the low of the 20th, which was also the high of the 16th, I think is a good level to perhaps look to go long. But you know, each day just sort of half trying to push higher, and it's actually quite similar to the Aussie dollar that you see here. And we put this back onto sort of a 90-minute just to show it a bit more detail. Each day you can see we're pushing higher, higher highs once, twice, 3, 4, and I guess the 4, 5 days in a row now, just pushing on, and the lows are getting higher, albeit yesterday as well. So just bear that in mind for Aussie dollar, which has come under quite a bit of pressure recently. Oh, 1 second there. Let me just make this chart a bit smaller, and you can see we have come down from really the 14th, middle of last month, and we're sort of consolidating now, as the FX pairs really are. I think if we were to push on again, you could probably get a trend line that goes up towards the R1 here for Aussie dollar. I think that's quite a good opportunity to maybe get to go short later on in the day. The pivot for now offering a bit of resistance, having we broke through the low of the day, a double bottom there. So keep an eye on that pivot and any potential resistance points above. But the Aussie dollar, I think, is another one to sort of look for that range bound trade. I think yesterday's lows could be an opportunity as well to get long and probably have a trend line. As we mentioned, the highs are getting higher and the lows kind of as well. A bit of a trend line on there might be worth having a go if we do sort of come down later on and the volume sort of slows down a bit, and we look for that range bound trade. In euro, obviously mentioned we've got data coming out in 2.5 minutes. I'll try to do this pretty quickly. You can see we're actually again sort of in this range, but in fact we're making lower highs here. So again, I'd be looking to have a bit of a trend on there to see if this has been half respected, and today's R1, yesterday's high, looks like a good opportunity there. The high of the day and the pivot as well, not bad. Just had a little sort of false breakout to the downside, but obviously with the data coming out, best to sort of hold off for the euro there. And with tomorrow on the cards as well, wouldn't be expecting necessarily the biggest move to come. Dollar yen, which is pushed above that R1, and we've got a few levels to the upside to be aware of that you see around. I'll just make this a bit smaller. Be hard to see here, I know, but really the highs of the 27th would be the next sort of levels to the upside that we made in the afternoon and the morning there as well. In terms of areas to look for support if we do come back down, the key level that we sort of broke through yesterday morning's high, the high as well from the Tuesday and the 29th afternoon, really good level of resistance. We'll keep an eye on that if we were to drift down later on. But with equities pushing on still, it could well be that we're actually looking for the yen to weaken, gold to weaken, T-notes to weaken still more. So it might well be that pullback doesn't happen. And just talking about the S&P here, from the low yesterday, we're up currently 4%, which is crazy from the low, considering it was always beginning of of the year struggling to get a move anywhere near sort of 1% high to low. So times have changed for now. In terms of the S&P, I think if we were to come back down to the high that we had on the beginning of the month, this could be a good level of support. But I think definitely a case to sort of wait until the afternoon. You can see 2:30 on the Monday, then the afternoon to evening on the Tuesday, and then obviously yesterday, very much so the latter part of the trading day is when the best opportunities come, if you like. So I think sit on your hands and wait is not a bad option there, unless it really does start to push on, and then you're looking there at sort of the R1 and the previous highs that we had at the back end of March as well. So data coming out just a minute.
54.9, that's lower than the expected of 55. Composite PMI 55.2, also lower than the expected of 55.3.
So yeah, that data really is completely within the range there. Just switch back over 54.9, the range 54.8 to 55.0. So a very small range, but you're stuck right in the middle. And as you'd expect, if we just have a quick look over there at the euro, very sort of minimal reaction, if anything at all. So to continue, let's just go back to the euro so you can see there, nothing much going on. But equities, yeah, I think is a case of waiting to see how that plays out.
German engineering orders, they've rose 13% in February on a year-on-year.
Okay, yeah. So I'll just wrap up the next sort of few charts. T-notes was one that actually caught my eye. I think if we can make our way back higher, and again, perhaps unlikely considering the sentiment of the market at the moment today, but if we can make our way back up towards the pivot area, I really like the look of a short. You've got the previous levels of support from the back end of March, and then the first sort of couple of trading days this week. Before we did break down, I think the pivot would be a nice opportunity to get short. Hopefully we can sort of drift back up there and sort of assess it as and when. But I guess ahead of tomorrow, non-farms, it could be a relatively quiet trading day. And I think really for equities you're going to get a bit of sort of sideways action until the afternoon, especially following such a big move to the upside. And I mean, just looking at the chart that we've got here, you get strong move down, next day strong move up, next day strong move down, and then obviously sideways, then up, down, up, it's and then it happened both ways yesterday. So hard to pick a direction, to be honest, and it could well be a case of just sort of waiting for the calm to come back into the market before really looking to take a hold of this. But equities just trying to push on there. Any questions, of course, please do let me know. Philip, I can see you were just looking to take the long in Euro USD. Okay, that's 15 minutes ago, before the data. But yeah, any questions, obviously, please do get them in the chat. We'll be posting charts throughout the day. One, I guess, to keep an eye on would be later on perhaps the DAX, if it was to come back down and have a go at sort of trying to fill the gap, but that seems quite far away, especially considering the sentiment of trade from yesterday evening into today. Have a good trading day, and I'll catch you all in the chat.